Thank you for joining us today. As lead manager of the MFM UK Primary Opportunities Fund, we'd like to know what your thoughts are about the day after tomorrow. So, Oliver.
Good morning, Marie.
Good morning. We're very aware that UK markets have been undervalued for some time. What exactly are investors waiting for?
Yes, so you're right. I think ultimately they're looking for some clarity. The pandemic has been a problem for the whole world, but the UK has been perceived to have had quite a poor pandemic. We've had more deaths than most countries, and our economy has contracted more than many of our European peers and certainly the US. We've also got the issue of Brexit, which has been with us for 4.5 years now, and that is coming to an head. There may be a deal, there may not be a deal. We don't know right now, but clearly, when that gets sorted, that should provide some clarity to investors and allow them to invest with greater confidence, knowing the future trading relationship the UK has with the EU.
Oliver, how do you see the UK markets playing out post-pandemic Brexit in the coming months?
So we're broadly positive on UK equities because of the valuation discount relative to other major markets. There will be some greater certainty surrounding the Brexit deal, if there is indeed a deal. And remember, the UK does have quite a number of quite economically sensitive stocks. I'm talking about sort of oil companies. There's plenty of travel and leisure and construction companies, also the banks. And what we expect to see in 2021 is quite a sharp increase in activity and economic activity in the world, but also particularly the UK. So we're broadly positive on UK equities.
You fish in a slightly different pond to your UK peers. How has the pandemic acted as a catalyst for companies to raise capital?
In the early months of the pandemic, so March, April, May, we saw a lot of companies wanting to raise money in order to repair their balance sheets. There were particular sectors, and I'm referring to the sort of airlines, travel, leisure, that were particularly badly affected by the pandemic. Their trading practically fell off a cliff in many circumstances, and some were, of course, forced to shut by the government. So what we saw was management wanting to shore up their balance sheet, because whilst they didn't have an immediate cash flow problem, they were conscious that if the lockdown went on longer than people expected, or perhaps there were further lockdowns, then they knew that by the end of the year they could have some liquidity issues. So they took the debate, if you like, off the table. They raised money, which would see them well into 2021, and hopefully, as the pandemic started to subside. Perhaps more recently, over the last few months, we've seen companies that actually have had pretty good pandemics, that are just wanting to raise more money to continue their expansion and perhaps look for acquisitions as well.
Oliver, do you find that there's greater activity in some sectors than others?
As I said, in the earlier stage of the pandemic, those companies that were most badly affected by the lockdowns looked to raise capital in order to bolster their balance sheet ahead of what was clearly going to be a difficult year. So we saw JD Wetherspoons raise money. It's the leading pub operator in the country, but clearly it had some short-term issues because its pubs were shut, and trading has remained subdued, even whilst they've been open. WH Smith was another company that raised money that we invested some more money in. Now, WH Smith is perhaps best known for its high street shops in the UK, but actually these days it's a lot more of a global business with concessions in airports and at train stations, and that's the real growth part of the business. But of course, this year again, because of the pandemic, that was very badly affected. But in both these examples, they are very good quality companies that, yes, have been having some short-term issues, caused by the pandemic, but we see them as long-term winners, going forward. They're market leaders, and we expect them to be good investments for us, in time. Recently, we have also seen companies in other sectors, other than those that most sort of badly hit by the pandemic, raising money as well. Hut Group, which is the largest IPO to come to the London market with a market capitalisation of over £5 billion. It's an online retailer, trading very, very well throughout lockdown, and has continued to do so. Also a company called HiQ, which is a fabrics coating company, where it puts their coating onto clothing, which stops the transmission of viruses, including COVID-19. So they've had a very, very good year, and have recently floated in order to expand. And we've also seen some software companies. One we're looking at the moment is called Bytes, which is an IPO. Again, people are spending more time at home using their technology for work, for keeping in touch with friends and family, and that isn't going to go away. So technology has certainly been a beneficiary of the pandemic, and we expect spending on technology to stay at sort of heightened levels.
Oliver, thank you for that. It's really interesting. But tell me, how are we able to take advantage of this?
So using our primary opportunities process, we typically buy into companies at the stage that they are raising money. And the reasons we do this are because when a company wants to raise money, it needs to show us how it's trading. It needs to put its books up for scrutiny, so we can be as confident as we possibly can be that the company is in the condition that it says it's in. So it reduces the potential for nasty surprises. Also, we're typically buying in at a discount to where the shares were previously trading at, because if a company wants to issue new shares, it will typically do so at a discount, and we're buying them not only at that discount, but free of stamp duty and free of commission. We have been able to buy into some what we believe will be very good long-term holdings of good quality companies that were stricken down by the pandemic. They had some short-term issues. Whitbread, which is the owner of Premier Inns, again, we see that as a market leader in the UK, a good quality company. And actually, whilst it's having its issues at the moment, because many of its hotels are either shut or the capacity is very much reduced due to COVID, once we come out the other side of the pandemic, Whitbread and its Premier Inn brands should be in a very, very strong position, because there are some of its competitors are finding life really hard. They will go out of business, and Whitbread has raised money, yes, to see it through and repair its balance sheet, but it's also got some capital as well to allow for its expansion. We've seen something similar with the Gym Group, which is the second largest gym operator in the UK. It's a low-cost model. Again, had short-term problems because its sites were shut. But again, it is a long-term beneficiary. It's very well capitalised, and it will be able to continue its expansion plans and benefit from the failure of some of its peers.
I can see that you've bought into long-term plays. Is there anything that you've bought for the short term, for the here and now?
So clearly, we bought a number of companies knowing that pandemic was very fast moving, and we knew the situation could get a bit worse before it got better. And in reality, that has played out. But we did buy a company called Primary Health Properties. It's a FTSE 250 listed company, and it owns and operates medical practices. Very, very stable, government-backed income. They raised some money because they wanted to buy some new assets. It's got a dividend yield in excess of 4.5%, and there's a real sort of steady eddy. And during the difficult times, acts as a steady eddy, if you like, in the portfolio, whilst there are other bits of the portfolio that may have gotten blown around a little bit by COVID news.
Oliver, I can see that you've been busy this year. How do you see 2021 panning out?
Yes, you're right. 2020 has been a very busy year. Lots and lots of companies raising new capital. The early stages was raising money to repairing balance sheets. But more recently, it's been the more typical fundraisings of companies wanting to raise money for expansion. And that's very much the theme that we see in 2021. There's lots of companies out there that actually, have done pretty well during the pandemic, healthcare companies, technology companies, and there has been a shift that has been sped up because of the pandemic to move online. So we expect to see that theme continuing. There'll also be some IPOs coming to the market that perhaps would have come to the market this year that have just been put back due to market conditions. So yeah, we're expecting another very, very busy year, which actually should be good for the performance of the fund, because we'll have plenty of opportunities to choose from.
Thank you.